Imagine you walk into a store and buy a $1,000 phone with your credit card. You tap your card, take the phone home, and something interesting has happened. You haven't actually paid $1,000 from your bank account. The card company helps complete the payment to the merchant. Now, instead of owing the store, you owe your credit card issuer. Pay your entire statement balance by the due date, and depending on your card's terms, you can generally avoid purchase interest. Which raises an obvious question. If customers can borrow money and potentially pay no purchase interest, how do credit card companies make billions? The first answer is interest. Imagine your credit card balance is $1,000, but instead of paying the statement balance in full, you make only a small payment. The remaining balance carries forward. Depending on the card's terms, interest can now make that debt increasingly expensive. And this is where credit card debt can snowball. The longer expensive debt remains, the more difficult it can become to eliminate. Consider two customers. Alex pays his statement balance in full every month. Ben regularly carries a balance. Alex may pay little or no purchase interest. Ben, meanwhile, can generate interest revenue for the issuer month after month. But here's what many people don't realize. Credit card companies can make money even from customers who pay in full. When you use a card at a business, the merchant generally pays fees associated with accepting and processing that card transaction. One purchase might generate only a relatively small amount within the payment ecosystem, but multiply that across millions of transactions every single day. Suddenly, tiny percentages across enormous payment volume become a very large business. Then there are fees. Depending on the card and how it's used, issuers may earn money from annual fees, cash advances, foreign transactions, late payments, and other charges. And then come the rewards, cashback, airline miles, hotel points, sign-up bonuses. Those rewards can feel like free money. So why would a highly profitable financial company give them away? Because rewards are part of a much larger business model. Revenue from cardholders, merchants, and other parts of the payment ecosystem can help support reward programs. Rewards can also make a particular card more attractive and encourage customers to keep using it. And this is where credit cards become interesting. The same financial product can produce completely different outcomes for two people. A disciplined cardholder can spend within their budget, pay the statement balance in full, potentially earn rewards, and avoid unnecessary interest. But someone who treats available credit like extra income can accumulate expensive debt that follows them for months or even years. That's one of the biggest psychological traps. Your credit limit is not the same thing as money you can afford to spend. A better way to think about a credit card is as a payment and borrowing tool, not an extension of your income. If you use one, understand when your payment is due. Consider automatic payments, and when possible, pay your statement balance in full. Know the interest rate, fees, grace period rules, and other terms of your particular card. Those details matter. Credit cards aren't automatically good or bad. Used carefully, they can offer convenience, protections, and rewards. Used carelessly, they can become extremely expensive. So how do credit card companies make money? Interest is a major source for many issuers, but the overall business can also include fees and economics tied to enormous volumes of card transactions. The next time you tap your card, remember that one tiny purchase is moving through a massive financial system operating behind the scenes. And once you understand how that system makes money, you can make much smarter decisions about how you use it. Follow for more simple explanations of how money really works.